Hello and welcome to the Stock Operator channel. I'm your host, Alex, and this is the mid-week market report, where we go over the action that's happening this week and what do we think is going to happen going into the end of the week and next week. If that's what you're into, stick around. All right. So this is the S&P 500, ticker symbol SPY. And as you can see, today we had a nice little pullback. And what I want to go over today is the analogs that we kind of identified on Monday that we're kind of using, and just see how they're relating to today's action. Because actually this kind of gap down after 1, 2, 3, 4, 5, 6, 2, 3, 4, 7 days to the upside is actually pretty common. So, even though it seemed like it was a bad day today, I think the NASDAQ was down 4% or something, but then we rallied back. It's actually very common in bullish markets. So let's dig in. So first of all, let's why don't we go to the market monitor and see what's going on there. Okay, so what I did today was, since it undercut this follow-through day, I just moved it to orange. We did kind of rally above the close, so it should be green again, but I changed it like before I made this video, so I'll probably have to change it back. So we're still in a a good rally. So that's what that orange is. So we are seeing a little bit less highs in this T2117. We ended at the kind of bottom third of the range, down 2% on the day. Back below the 10-day exponential moving average here, and 3% below the 21. So, still a little bit negative, but we're in a rally attempt. We should, one thing to note is we had a distribution day or two distribution days within the first 3 days after the follow-through day, which typically leads to a failure of the follow-through day, which is why we undercut the lows today. But we could even, close below the lows again and get another follow-through days at another time. So that's something I'm watching for. So something that's very interesting is this 10-day trend has been below 1 for this entire kind of follow-through day mini rally, which is bullish, because you don't really see that in crash scenarios. So that's why I'm going back to these kind of bull market correction analogs that I'll show you later. The put call ratio is at 1.03, so we're getting back to kind of more panic coming in, which is good. It's a good sign. We got a pick up in the VIX, but as you can see, there's a big decline, but the VIX didn't really go up that much. So that's another kind of bullish thing to look out for. The 20%. The number of stocks that made a 20% upside move in 5 days has now come down from 138 to 35. That's also good because we're getting rid of the kind of froth in the market. Okay, so moving onwards, more lower lows. Okay, 300. That's a lot of lower lows. Okay, bearish combo. A lot of stocks were at the lows today, 457. Nothing in the Bollinger Band indicator. Only 26 stocks have gone down 5%. On big volume today. The short-term momentum down is kind of hovering at 300, short-term momentum up, hovering around 300, which is another thing that if it starts to go down could be short-term bearish. And then we're seeing, the TD buy and the TD sell, the oversold and overbought indicators just kind of flat. So kind of in no man's land here. And then, of course, the long-term breadth is still above zero. On the New York, it's of course negative on the NASDAQ. So altogether, we just have a mixed signal market that a little bit of panic, but some bullish signals and some bullish signals that could be turning short-term negative. So let's dig into some analogs here. So this is our market today. Okay, so this is the S&P 500, and you can see with this green line right here, this is the yearly moving average, and then this is the quarterly moving average. These are moving VWAP averages. Okay, so that's why you can see a dip when the volume comes in. Okay, of course my target was for this bounce, But let's go see some analogs here. Okay, so here's the top screen. So let's get started here on the left side. So this market right here, I believe this was COVID. Okay, and in COVID, you could see we had this big dump, but then we had 1, 2, 3, 4, 5, 6, 7 days to the upside, and then we had this gap down, but we had less volume. Okay, but we had the same gap down at the same day number as we had today. If I go back to the main screen, see 1, 1, 2, 3, 4, 5, 6, 7, gap down. Okay, going back to the COVID market, 1, 2, 3, 4, 5, 6, 7, gap down. So the next day in COVID was bullish. That's something to consider if we're using the COVID thing as an analog, even though the moving average is a little bit different because they were below, the quarterly was below the yearly, which is a little bit different. Okay, moving onwards. Here's the 2022 analog. I'm kind of using this one as the analog. So 1, 2, 3, 4, 5, 6. We gapped down on the 7th day here, but then closed kind of at the high of the range and had a nasty day and test this low. A little bit different, but similar kind of structure where we had 2 kind of negative days. But then we rallied, and we had a nice, decent rally where you could, put some more shorts on or something like that. So that's something to consider. So similar action. Okay, so here is, which market is this? This is October 18th. Okay, so 2018. This is 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8, 9. Gap down here, but this is above the moving average, so it's a little bit different. So I put this in here, but I don't think this is an analog we're going to be looking at. It's a little bit too different. Okay, so let's move onwards. This is something that was pretty interesting to me. This is the 2015. So we had the big move down, similar to what we just had, kind of a surprise. 1, 2, 3, 4, 5, 6. And on the 7th day, we had the gap down with more volume, which is, if we go back to what we did today, 1, 2, 3, 4, 5, 6, 7, gap down, higher volume, marginally. Okay, so that's something to watch for. And then we kind of rallied from there and then tested that average. I mean, I kind of like this one. This 2015 is what I'm looking at as pretty close. Okay, and then if we move on here, this is 2011. From the low, 1, 2, 3, 4, 5, 6, 7. 7 days upside, gap down, big volume, continuation for 1 day makes another new low, and then we get the rally. So this is 2011 is another one that's very interesting. Let's do it one more time. 1, 2, 3, 4, 5, 6, 7, and then if we look, and then we got the gap down. Here's today's market. 1, 2, 3, 4, 5, 6, 7, gap down, and the candle's not looking that scary. Okay, so back up to here, and for the final analog, this was 1998. Yeah, so 1, 2, 3, 4, 5, 6, gap down, bigger volume, but we closed in the high of the range and then we rallied up. So it's kind of similar between all of them, and between all of these 1, 2, 3, 4, 5, 6 different analogs, basically in one of them. Which one is it? One of them, we went a little bit lower. This one did not go lower. This was not an analog. Okay. Yeah, this one went lower by 2 days. And then this one did not go lower. So it's kind of a mixed bag. But it's looking like we're just going to continue to chop around here. Yeah, and I like this one. And I still believe that we can test that, quarterly moving average if it crosses. If I go back one more time, this quarterly moving average if it crosses. But I could totally see, if we go back down maybe a little bit, maybe another 2 or 2.5% in the S&P, maybe 2%. Or if it keeps going up, that would be bullish. So that's kind of the way I'm reading it. Yeah, if you enjoyed this content, please feel free to comment and like and subscribe. And we appreciate you. We're getting more subscribers. We're, I think, above 60 now, which is great. Thank you guys so much for the support and hope to see you on the next video. Cheers. All right, take care.